everyone, I'm Debbie Giordano. You're watching Valley Homes on TV. You've tuned into Channel 26. We air on Monday, Wednesday, and Friday at 6:30 p.m. and Saturday and Sunday at 9 a.m. And today we have a guest star, Ken Stray. Did I get that right?
Stray is right.
Stray is right. With Credit Line IQ. Did I get that right?
You got it right.
Okay. Thanks for joining us.
Oh, it's my pleasure.
Well, as I say, we're missing Todd today, but he may come into the show a little later. But Ken, Credit Line IQ.
Yes.
What do they do? These are folks out here watching that are homeowners or renters. What can you let them know about your company?
Well, our primary focus is in education. So we want to educate consumers on how to maximize their scores, but more importantly, understand them. We're facing an awful lot of turbulent times.
Well, you and I were discussing that
Right.
just off the air, that this is unprecedented times.
Yes.
In many folks.
So our primary focus is education and
Okay.
consulting.
Okay, okay. So what questions should someone ask if they're considering, say, a credit repair?
Well, that's a good question as well. The number one thing, you should make sure you're dealing with a reputable company. They're actually,
So there's scam companies out there.
Yeah, we actually were formed in 1990, so we've been around for
Okay.
20 years. Most companies have basically come out of the woodwork, and they do a lot of media blitz to get people in, and yeah, they probably are less than attractive as far as wanting to help people. They're more interested in the bottom line.
One of the things I wanted to know, Ken, is what can some of the things that some folks do themselves in terms of credit repair?
Well, I think the very first thing is, yeah, there is a lot of things that consumers can do on their own, but primarily, do they understand how to read a credit report? Credit reports are pretty inclusive, and understanding what impacts credit is probably the hardest thing. Most people look at, just their score and form an opinion, but we look at it very, very differently as far as what kind of damage and how it impacts their score.
Okay. So the client comes to you and they've already assessed their situation, or your job is to assess
Yeah,
where
actually,
they're at?
people actually come to us because credit's got in the way of something. We don't advertise, we only work by referral.
Oh, really?
So that means that when someone has come to us, they've come to us from someone they trust. And that person, whether it be in the mortgage business, real estate, or even past clients, they'll come to us that way.
Well, that's why Ken is here with us today. Ken actually was referred to me by one of my clients who he had helped out. And so for me, that's one of the best ways to find, good service providers is, if someone's willing to put their name and reputation on the line and say, hey, they've done good work for me, that says a lot.
Well, Ken and I were
Right.
discussing earlier that there are a lot of scams
There are.
in this industry.
There are. I see them all the time. I have folks come in, to pitch things to me all the time about credit repair, and we can fix your folks' credit reports. Send them to us. Reason Ken's here is because I trust the work that they do.
And in your line of work with lending, I mean, credit is key. That's one of the common elements, denominators, that they have pristine
Well,
credit.
this is probably the number 2 question I get asked. Number 1 is, what are the rates, right?
Rates.
But then the second most common question I have from people is about their credit and their credit score and what goes into that. So maybe, Ken, you can talk about perhaps what are some of the common errors or things that you see in a credit report, and how often are there errors in credit reports?
Well,
That's a good question.
Yeah, that's a very good question. By law, creditors are allowed to put information on your credit report, and many, many times they have inaccurate data. So that's one scenario. The other thing is that people looking at credit, they are exposed to some of the current events. Like, for example, many of us know that foreclosures are prevalent, short sales are prevalent, and we're starting to see a great deal of those, as well as high interest rate credit cards, closing accounts, just a whole variety of things.
So what is it that impacts somebody's credit score the most?
Good question. 35% of your score is primarily made up of your payment history. To give you a great example, a 30-day late on a mortgage payment can drop your score over 100 points.
Oh my
Well,
goodness.
in fact, you may not be able to get a mortgage if you have a mortgage late in the last year. That's how tight credit has gotten with banks these days. So, you know, making sure you make those payments on time is critical.
Exactly.
That's 35%?
35%.
What makes up the other 65%?
There's actually 5 increments. So 35% is number one, which is late payments. 30% has to do with the maximization usage between your credit limit and what you use.
So those that are stretched out to the max
Exactly.
of their credit limits,
And what's
weaken their credit scores.
Exactly.
What's the formula that's used to determine? In other words, how does the credit agency, if you're 100% maxed out, say on your credit cards, how much would that drop your credit score?
Well, the formula actually looks at 3 increments. One is when you attain 30% of your credit limit usage. The second is at 50%, and the third is at 100%. And the general rule of thumb on what will hurt your credit and how much is how high your score is. So the higher your score, the more that these are going to impact your score. So to answer your question specifically, probably for someone with a 700 credit score to be maximized, they may be losing 30 or 40 points.
Right.
Okay.
Now, Ken, my understanding as well is that the credit reporting kind of double dips on those, the maximization of credit, if you will. That is, they look at the aggregate of all of your revolving credit in your percentage, and then they go back and they look at each individual account as well. So there are some strategies that people might be able to use in terms of how do they spread out some of the credit amongst various revolving accounts that they have.
Exactly.
And I know that's something that you guys will do in terms of coaching people with how to maximize their credit score.
Yeah, we actually break them down into 5 different increments, but there's over 220 different increments in the algorithm that FICO looks at. So, but we break them down into, let's just look at the individual trade line and work on something small.
Okay, did we touch a short sale? We talked about that offline too.
Yeah.
Foreclosure or deed in lieu of foreclosure, obviously. How does that affect the credit history?
Well, we are seeing a tremendous amount of those right now, and it does impact. But the key to any of these events, we call them life events, and they are happening, is going through it the best way you can. So what damages the credit score the most? Late payments. So a 30-day late going to a 60-day late, once you receive a 90-day late, it's as bad as a foreclosure. That is the damage. So a foreclosure without any lates, of course you're going to have lates with foreclosure, but a foreclosure on a short sale, the best way to do that is to not have the late payments. That's the damage to your score.
Okay. And a deed in lieu, for folks that don't know, that's where you just basically give the keys back to the bank.
Correct.
And so the key to that, what I'm getting is whether or not there have been late payments associated with that mortgage.
Yeah, we're actually, you know...
Which would typically be the case. Yeah.
Correct.
Yes. So we're actually seeing quite a few of these options. The banks are overloaded. So do they accept deed in lieu? You know, it's difficult right now to say whether they'll do that or not.
Okay, very good.
And you know, we kind of talked again about you and I have talked about the upside down, where they owe more than what the loan balance is, the property value is less than what they owe, and do folks need to walk away or what? But it will ultimately affect their credit, and so I think that has to be weighed in as to how the big talk now is to go ahead and just vacate the property and give it back to the bank, but I think it's imperative to understand what the downside of that is. Let me ask one, how long, did we talk about this? What's the length of time that remains on a person's credit, say a foreclosure or a deed in lieu of foreclosure? How long is that affecting their credit?
Well, there's different criteria. The bottom line is most things damage can stay up to 10 years.